Hi, I'm James Robinson, and this is my stock pick of the week. This is the fourth video in my 5-part series on Oil-Dri Corporation, symbol ODC. This time we're going to talk about the company's dividends. So some of the people who follow me are dividend investors. They're people who maybe are retired or who are planning on saving for retirement. And they're looking for companies that have good value characteristics, that are very safe companies that are going to be around for a long time, and that pay really solid dividends. And for those people, I don't think it's enough to just say, hey, here's what the dividends are. I think we should do a deeper dive into the safety of those dividends. Having said that, the first place that we start is just looking at the dividends. And we always look at dividends in two ways. We look at them as what's the total amount of dollars that company is spending in dividends and what's the amount of dividends per share. And we do that because oftentimes companies are buying back shares, and you want to find out if the company's allocating the same amount of money to dividends, or if they're maybe reducing the amount of money they're giving out in dividends, but the dividends are either increasing or staying the same on a per share basis because there's a lower share base. So we like to just take a look at that. Now, in this case, this company hasn't really bought back any shares, but you can see the dividend has performed really nicely since 2007. It's gone up every year, pretty much in a straight line. The dividends per share have been the same. You know, there's every occasion there was this bump like you see in 2011 and 12 and 13 where they kind of go up one year and down one year. That's either a situation where there was some accounting issue going on or they paid a special dividend or something. But in general, the numbers have just been very solid, going up and down. Going up in a pretty lockstep method year after year after year, which is, again, if I'm a dividend investor and I'm looking to fund my retirement, for example, I want to know that there's something there that's got a long history of paying dividends. That's something the management's committed to doing. And there's no question that Oil-Dri is a company that is absolutely committed to doing that. So having said that, I think you should look at dividends through 4 different prisms. The first one is what is the yield and the growth of that yield. The second one is how safe is the dividend in the context of earnings, and the next one is how safe is the dividend looked at in the context of cash flow. And finally, what's the dividend safety in the context of the current debt load for the company? In other words, is the debt load likely to create a situation that might swamp the company's ability to pay dividends to the shareholders? So the first thing we look at is yield and growth. Yield is just the return on investment. So if you have, $10,000 invested in a company and has a 5% yield, that means that it's going to pay you $500 a year. The yield for this stock is about 2.93%. The average S&P 500 yield is 1.73%. So it's just under twice the S&P 500. So that's very, very solid. The dividend growth has averaged 4.6% over the last 5 years. So if inflation has been 2.5 or 3%, they're about 1.5 times inflation. That's really important for dividend investors. What that means is if you have enough money to retire today and you put, in theory, all of your money in Oil-Dri, and let's recognize you probably will want to diversify, but let's say you didn't, you put all of your money in Oil-Dri, based on this company's history, and this history goes back to 2007, you'd be getting a raise relative to inflation of about 50%. So if you needed $100,000 to live and inflation went up to $103,000 the next year, you'd be getting $104,500. So you'd be gaining on inflation every year. And as a dividend investor, that's a really nice feeling. So again, the company's paying a yield twice the yield of the S&P 500. And we've got a dividend growth that is significantly more than inflation. Those are 2 things that if you're a dividend investor, you should really be looking at. Let me talk for a second about this graph just so you can understand what's going on. The blue line represents the dividends that are being paid each year, and that's per share, and that's relative to the number on the left side of the graph. So, you can see that in the final year, they paid $1 in dividends according to the blue line. And the first year they paid, in 2014, they paid 85 cents in just under 85 cents in dividends. So that's how that works. And then the red line is the amount of increases. And you can see that the increase is going down gradually over each of the last 5 years. That's because the company's made a dividend increase of exactly the same amount for the last number of years. And they're paying that exact same amount on a larger and larger basis. So my prediction, though, is that in the next year or 2, you'll see that trend change and the company will start to pay a larger increase each year. And that'll mean that the growth in the yield should increase at more than 4.6% over the next 3 or 4 years. That's my prediction. I'm just basing that on looking at the fact that these numbers are starting to get to the point that I think the company's going to want to do better by its shareholders, but we'll see if I'm right about that. So next we look at dividend safety in the context of earnings. Now, what we're looking at here is if a company paid 100% of its earnings out in dividends, they would have no margin of error for something that would go bump in the night, right? A company can't, in the very long run, pay more money on dividends than it makes on earnings. It would then start to go through its cash on hand and its assets, and it would bankrupt itself over time doing that. So a company's not going to consistently pay more in earnings or more in dividends than they make in earnings. And in fact, most companies pay some fraction of their earnings in dividends. And so what we're looking at here is trying to determine if this company has a safe margin between what they're making in earnings and what they're paying in dividends. We call that the payout ratio. So what percentage of the earning is being paid out to the shareholders? This company's payout ratio is 37.7%. That's pretty low. The average payout ratio for the company has been 51%, and that is related to the S&P 500, whose average payout ratio is 40%. So this company has traditionally paid more and more of its money out to shareholders than they've done in the last couple of years, but they're still paying more out over the last 5 years than the S&P 500. So this is a pretty long way of saying that this company, based on the last couple of years of earnings, should have no trouble continuing to pay this dividend, and in fact should have room to increase the dividend at least the rate they have been, and I think at a larger rate than they have been. So the dividend safety in the context of earnings for this company is very, very strong. It's very, very safe. Some of you realize that companies can do goofy things with their accounting and with their earnings. And so I also like to look at dividend safety in the context of cash flow, because that's a harder number to fudge. Cash flow is pretty simple. It's pretty black and white. How much cash came in and how much cash went out, right? So what I'm looking at with this chart, I'll walk you through the last section, which is 2019. The cash flow from operating activities was $42 million. This is in millions of dollars, obviously. So the cash flow from operating activities was $42 million. That is how much money the company took in total. They had capital expenditures of $14 million, which left $27 million of free cash flow, right? And that's sort of free cash flow is the amount of money that the company can allocate to whatever they think makes sense to allocate it for. Of that $27, the company allocated $7.03 or $7 million and 3 cents to dividends. And so that works out to a cash flow to pay dividends of 25%. That number is very low. That means the company's got tremendous ability to, it could have paid out 3 times as much and would still have additional free cash flow left for other things. So that number is really good. We're comfortable with that. Having said that, the average payout ratio for the last 5 years is a little suspect. But if you look closely at the numbers, you'll see that there was one unique year that happened. Cash flow from operating activities in 2017 was only $10 million, which was artificially low, which we don't need to get into the reasons why. It was a number of years ago, but it was artificially low that year. They had the same about the same amount of expenditures they seem to have every year, about 15 million, which left them free cash flow of negative $4 million. Now, despite that, they managed to pay, or still paid, $6 million in dividends. That worked out to a payout ratio of negative 139%. So in other words, they paid out more money than they had in free cash flow. That's not sustainable, but it's a one-time blip. If you look at the 2 years before that and the 2 years after that, it's been pretty stable. So the average payout ratio for the last 6 years, I've got a couple of asterisks next to that. I think it's okay to ignore what happened in 2017 and kind of move on and assume that that was a one-time blip. But that's what's happened with dividend safety in the context of cash flow. Again, I think this company is very safe when looked at through that prism. So having said that, let's look at these. Let's look at this chart and we'll look at the bottom row. I'm sorry, the top row and the bottom row. So if the interest rate that the company was paying was 4%, that would mean that would change the company's interest rates, and they would be paying an extra $720,000 in interest. The new interest-adjusted cash flow then would be $27 million. They're going to pay $6.66 in dividend. That means free cash flow minus dividends would be $20 million, which means their dividend payout of cash flow at that debt level, that interest rate, would be about 24%. So as you can imagine, if the interest rates were to go up, that would mean there's more money being paid in interest, and that means there's less money for dividends, right? So that's the premise. So if we go to the bottom line, which is 20%, so now we're assuming that it's catastrophic, right? The world's coming to an end and we have 20% interest rates, which we've had in the past in America. It happened in the 80s. At that point, the reduction in cash flow would be $3.60. So they'd be paying an additional $3.60 relative to what they're paying now. Sorry, $3,600,000 relative to what they're paying now in interest. That would mean the new interest-adjusted cash flow would be down from $27 million to $24 million. They're still paying the same $6.66 in dividends. Free cash flow minus dividends would be $17 million. So they'd only be paying $27 million. They'd only be paying 27% of their free cash flow to dividends, which is fantastic. Now, this is the education here that I'd like you to get is this company has very little debt. And so when you have very little debt and you raise the interest rates to some enormous number, it doesn't really affect your operations. And that's one of the reasons why I really like companies with low debt, because it means that my dividend is much more likely to be assured. And this illustrates it. Even at 20% interest rates, the debt is not going to be an issue. It hurts this company's ability to pay its dividends. So that gives you sort of a sense of what's going on there. So by way of summary, this company's got a dividend which has gone up basically in a straight up pattern since 2006 or 7. It's gone up the same amount in terms of ratios, both on a absolute basis and on a per share basis. The company has a 2.9% yield. It's twice roughly the yield of the average company S&P 500, and that yield is growing at 4.6%, which is better than inflation. The company has a current payout ratio of 37.7%. I think they're going to increase their dividend dramatically because that ratio is kind of low for them. Over the last 5 years, for example, the dividend payout ratio has been 51%. The average payout ratio for all S&P 500 companies is about 40%. Company's got no problems with paying the dividend in relation to in relation to cash flow. They're about 25%, and debt is not going to be a problem with this company's ability to pay dividends. So that's it for Oil-Dri for the dividends. If you're a dividend investor, this is a company you should really consider. The yield isn't spectacular at 3%. There's obviously better yielding companies, but between the yield and the growth and the safety, it wouldn't be a bad company to add to your portfolio. I'm James Robinson. Again, thank you for your time. Please subscribe, please like, and please let me know where you're watching from. Thanks.